We're so excited now to jump into the best ever pitch slam. We have 4 finalists up here today. They'll be introduced to you in just a moment, but I want to make sure that we've got a variety of offerings kind of that have made it to the final round of the pitch slam. You're going to be hearing from diversity of asset classes, and that just goes to show that the model that we have learned, that we are applying in real estate syndication can be applied to a number of different things: campgrounds, debt funds, mobile home parks, you name it. So I'm excited to welcome up our panel of judges, our esteemed judges who are putting their capital on the line. Let's give it up for Ben Lapidus and the judges.
All right, round 3, here we come. As Garrett said, we do have 4 finalists today. All 4 finalists are winners as far as I'm concerned, because for the first year ever, it is a free-for-all on investment a la Shark Tank. There is not going to be a collaborative winner per se. The first place winner is going to be whoever gets the most cash out of these 6 fine, fat wallets we got here up on stage. Looking at you, Vina. So today, I want to celebrate the 4 finalists that we already have before we get started. So we've got, if I get a round of applause for each one of these folks. Ferd Neiman from 3rd, 4th Properties. Congrats to him. Don't come out on stage yet, Ferd. Just a round of applause for Ferd. Kevin Houston from KCN Campgrounds. Alex and Natalie from ILS Legacy. And Chris Reese from MJ REIT. So we have got mobile home parks, campgrounds, private credit, and cannabis. So just a quick question from our panelists. I noticed we don't have any value-add multifamily with a twist up on stage.
Oh!
Any thoughts about that? Anybody got any kind of high-level thoughts about why that might be?
Well, okay, I'll hop in first on that one, Ben. It's a good question, but let's just expose ourselves to the fact that myself and a few other panelists already have a lot of multifamily, and it's important as an investor to diversify, right? And so although there were good multifamily presentations, I think this panel was perhaps a little bit like, we already have that asset class, and so maybe our interest was towards other asset classes, not because the multifamily presentations were bad, but because a lot of this panel, except for our Beyond Multifamily knucklehead down there.
So you're saying it's a judge problem? It's a judge problem?
Yes, it's not you, it's me.
It's not you, it's
yes,
me. Okay.
That's
Do you
what
have
I'm trying to say.
any other answers?
Yeah, let me ask the audience. Who here is going to start looking
goodness.
at retail, office, industrial? Yes, let's go. Noise. I can't see hands. Noise, please. Yeah.
Yay.
All right. Well, that's another answer.
I'll just say that I think anybody that came and pitched multifamily was really brave, because so many of us are so heavy in the asset class. We can look at it with a deeper lens, and we can go further, faster, and decide yes or no on it. So I think it was really brave for the multifamily investors. I'm so proud that you guys came up here, because this is a hard stage, and then to do it in the asset class that you have so many experts in it is even tougher. But to Matt's point, I think we all want diversity in our portfolios, and I have a lot of multifamily exposure, so that's why these ones made it for me.
Or it's just people want higher cash on cash.
Here we go.
Stop.
And I would say, Ben, that everybody who is up here is already winner, because I was on this stage and I did not win. But just to get an exposure and be able to talk in front of so many people, I think that's a win in itself. So I think that's very great.
And I'll pitch for anybody here in this audience. I hope that there's somebody here that's inspired. Who in this audience wants to be on the stage next year? Wants to be pitching a deal in front of this panel next year? Got it. The thing is that I know people that are not here in the finalists that got investors from this room because they were here, including the multifamily guys, including everybody else too, right? So it's not just about getting money from this panel. It's about there is real money in this room, and being up here exposes everyone here, not just this panel, but also to the room too. So make a plan. I want to see some lots of new deals next year too.
Appreciate the plug, Matt. You're good at that.
You're welcome,
All right.
sir.
Well, with that said, in
welcome.
addition to the cash, in addition to the exposure, it's bragging rights. So we're on an all-out brawl for the rest of the 45-minute period we have here for who gets to brag about being the best ever conference winner of the best ever pitch slam. So to start things off, we're going to bring back Ferd Neiman to talk about his mobile home park deal. Ferd, come on out. We're going to do 6 minutes today, so we have a little bit more time to hear from Ferd. All right,
I'll try to slow down a little bit. So Ferd Neiman with Neiman Investment Group, again, coming back to talk about Timber Ridge Mobile Home Park. Structurally, here's our organization. We've got Neiman Enterprises, we've got the investment group, the law firm, Augustine Property Management's our property management in-house division, and then Mobile Home Park Lawyer podcast is where I bring in a lot of investors, bring in a lot of clients, kind of my marketing on a national footprint. The deal structure, we got the GPs, which are all internal employees, including myself. No co-GPs on this one, but I've never done that actually in general. We've got limited partners, we've got a holdco, the investors LLC. We own the mobile homes in a separate LLC than the land for diversification and risk mitigation purposes. So there's 3 new LLCs there, and then we're going to rebrand it to Paradise Lane South. We have another park called Paradise Lane in the same market with a good reputation. This one's got a bad reputation. I mentioned some of that the other day. And then APM is my in-house property management company. Here's our track record. I've bought 24 deals, 22 off market. We try to buy kind of lower price, value add deals and then fix them up. And then the first couple deals we flipped and sold. If you see 2 stars next to the name of them, that means that we've already sold it. For my first deal, Valley View was in my hometown. Bought it for $695. Interestingly, got 100% finance on that. Fixed it up, filled it up, same business plan as this new deal, and we sold it for $950. So the current value on that is actually the sales price. I don't know what it's worth today on that one because I don't own it anymore. The others would be our current value. We've bought some sites as low as 16, as high as 153. Peaceful Homes is one there in Kansas City where I live. I bought it with a 22 occupied for $1,250,000. Just the land now valued is at $8.2 million, and that's using just an a la carte cap rate. If we actually rolled these up together, we'd probably get a decrease of 100 bips on the cap rate, which would push the values higher. But this is what's on my PFS. I've put together an 8-figure personal balance sheet from these properties right here, which helps me on some of these deals, get good financing, get good leverage on some of the construction loans, which then requires less equity, which then by default does not dilute the LP equity because we don't need as many guys in every deal. We can talk more about this if we have time. Some of these deals we specifically bought to strip for their parts. So some of them, the current value or the sales price was less because we would, like one park in particular in Arma, it was 16 sites, 10 occupied, had 10 nice homes, but in a low dollar market. So we bought them, we took the vacant homes, put them in a high dollar market in central Missouri to get that spread of say $100 on lot rent. You know, a vacant site is worth about 0 or really less because you got to mow the grass and push the snow. An occupied site, if it's got 325 rents like this market at a 6 cap at a 40% expense ratio, it's worth $39K. So it behooves us to take low dollar homes in a few instances and put them in higher dollar markets. So that's what we've done. So some of these you see the value's gone down. That's the reason why. It was a strategic business plan. What's this look like in real life? Well, it's providing more affordable housing and higher quality affordable housing. So this property here, 22 out of 93, a lot of desolation, looked like crap. This was what we would probably call a trailer park. We wanted to turn it into a manufactured housing community. So how do we do it? We clean it up, we put more butts in the seats, we sell the homes at cost just to get the lot rent revenue. We don't need to make money on the homes. Well, that makes it a lower price point and gets more people kicking in the $325 a month, which eventually is $400 a month and so on. So the park, 10x on revenue, 100x on quality of life for our customers. We do, part of the quality of life is we add amenities, pickleball, covered grilling areas, covered mailboxes, dog parks with amenities, playgrounds. In the center there you see one where we repaved the streets, we did the concrete work in-house. We don't do asphalt in-house, it's a different animal, but we can do the concrete. This specific deal, again, 54 sites, 11 vacant. So again, an occupied space is worth $39,000 in this market. A vacant space is worth 0. So I'm looking to add 39 times 11 on value, and really it'll be more than that by the time we're done because that'll reduce our expense ratio, and also it'll make it more aesthetically pleasing, more stable, which would also reduce the cap rate. This forced depreciation, something you can really only do in mobile home parks. You can't do this as well in multi and some other asset classes. This one's got public water, private sewer, below market rents, and we're going to take advantage of better community management, better operational management, a new branding on this particular property, and then just play into the supply and demand economics that I talked about the other day. And there's a lot of portfolio synergies with the rest of my portfolio. Return metrics, here they are. This is a relatively small capital raise, $25K minimum investment, got a target 10-year hold. You got the Class A folks are going to get an 8 pref, and then an 80 to them, a 20 to me. After we hit the 18 IRR, it goes to 50-50, which equates to about a 30% IRR and a 5x equity multiple. Some of the deal risks, you know, people say, oh, it's got a private sewer. Well, we already got a $150,000 price concession because of the private sewer, and I've already got a lagoon operator in the same market, in the same style of lagoon, a 3-stage natural lagoon. Some people think it's a small market. I don't. It's 100,000 metro. I've been successful here. I own 2 properties currently. I've had 3. I've had duplex in this market, single family in this market. My family lives in this market. And then exit price, we're going to do a portfolio sale. So special offer today for this group, I'm gonna let you guys on stage combine for the Class A. So you don't have to write 250 checks apiece. 5 of you write 50, you're in. And also, so here's what it looks like on the economics. You know, you get rid of that Class B, and you got the Class A return. But since this is a smaller deal, I have this money in checking. I just pulled out 1.7 on a refi on Monday. But I want to do business with you guys for this deal and for the next deal and for the one after that. So I'll commit to fund any remaining dollars that you guys don't put in. And if I get first place, I'll let you guys choose. Is this a single asset PPM, or are we going to roll this into a multi-asset fund? I've got a $10 million fund coming behind this. We'll get the people in the crowd in on that. We'll get other investors in on that, your market. That's a special offer just for you guys. And then if it goes well, you're going to want to invest again, and I'm going to give you first right to place capital going forward. Any questions from you guys? Seems like a no-brainer.
All right. Appreciate you, Ferd. Getting heated. You got that?
It's a very generous offer. Can the audience get in on that too?
Oh,
That's if your guys' call.
Yes.
Yeah. Let's go.
Okay, the audience can get into. Deal.
I have a question on that lagoon. Have you had a lagoon before? And have you dealt with one, and are you familiar with them?
I am. I'm not an expert on lagoons, so we hire an expert. It's kind of like a phase 1 environmental engineer. There's guys that do that are environmental engineers. We have a lagoon 2 miles away from this property. I also have a lagoon in Marshalltown, Iowa. The one in Iowa has like a bubblers in it, which means it can be smaller and it can eat up the bacteria quicker because it's got the air. This one's a 3-stage lagoon, so it goes from a big pond to a smaller pond to a third pond. So it's tested monthly, and then I had it inspected it costs about $5,000 to have this thing inspected. There's nothing wrong structurally with this lagoon, it's just full. This park is over 50 years old and it's never been dumped. So it's got about 2 years left before we're gonna have to desludge it, which is a big expensive process. So rather than just absorb that cost, I dropped the deal 6 months ago. So the guy just dropped the deal, said I'm not gonna absorb the 150. They came back to me through the estate and everything, and they said, all right, we'll take your price. So that's where we're back under contract on this.
Hey, good.
Just so I'm tracking, because I'm not familiar with sewer lagoons. So when people poop and pee, it goes right there?
It does.
Okay, and then, is there a stench?
Interestingly, no, it doesn't smell. I wouldn't go swimming in it if I were you, but it doesn't
not a
smell. It's got a
pool.
green.
And how long, once it's dredged, how long is that solution in place for until it needs to be dredged again, and then you start smelling?
50 years, probably. I mean, this one's been over 50 years. It's never been desludged. It's at about 90% capacity. Now, right now, they're not full occupancy, so when I put 11 more families in there, we're going to be using the toilet, the dishwasher, and so on more frequently, so it's going to fill up at a faster clip. But this is in rural America. The cities have these sort of things. I mean, it's not uncommon. This is a mile or so outside of the city limits, so it's not viable to hook up to city sewer. Otherwise, I probably would, because that's going to drop my cap rate another 50 bips immediately and reduce the OpEx of having to pay the engineer. But it's going to cost $1 million to put the sewer line in, so I'd rather just continue to operate as a lagoon.
A couple more questions. One is, let's say you get your target raise. How much what's the minimum that you're putting in, you and your company?
Normally, I put in at least 5%. On this deal, I'd put in, and I was going to do this deal myself. If I wasn't on the stage today, this deal would already be funded myself. But I want to do business with you guys and you guys going forward. So this is a great opportunity to start that off.
So, sorry, what's the minimum?
I'll commit to 5% or whatever you guys don't match. If you guys put in a total of 100, I'll put in the rest. I'll put in 300.
Got it.
If you guys put in 25, I'll put in 375. If you guys put in all 400, then you tell me you want me to put in my slice. I'm guaranteeing a loan, construction loan. I got a good relationship with this lender, so I mean, they don't really care where the money comes from as long as I'm on the note.
And the new structure of this is that multiple people could win. So if you do receive money, but you don't get the total amount, because I heard what you said, if you get first place, then we can decide if it's a single or if it goes into a fund. Can we still help decide on if it's single or goes into the fund if you get, say, second place, but you still get money?
I don't think I want to mess with that additional headache. I think if you guys think it's a good deal, give me first place. If somebody's better, hey, good for them. God bless them. But I think this is a good opportunity. I've never done this before. I've never pitched on stage. So I'm,
Can I say
I wanted to
that?
give you guys something unique. But I know right now somebody told me last night that funds are not in vogue because it's the hidden ball trick. You want to look at it, you want to underwrite it, you want to shake the deal. So if you guys want to do a single PPM, I'll do it. I was planning on doing just a fund too, but I only had one deal under contract. So I'm like, well, if I just have one, of this bigger fund, it may not be.
Can we jump in?
Yeah,
Because
go ahead.
we can work all that out, right?
Okay.
So, but we only got a minute left, so go ahead.
Yeah, I have a quick question. So it more and more looks like to me more of a partnership, JV, or even GP stake. Can you go back to your slide about acquisition fees? So you have, I think, 3%, yeah, right there.
Oh, this one?
The acquisition
one
fees.
more.
the
Sorry.
Yeah.
There
you go.
So 3% acquisition, 4% disposition, and 6% property management. So is there a room for negotiation there if it looks like more like a partnership?
You say, I couldn't.
Is there a room for negotiation?
Is there room for negotiation there? I mean, the 6% property management fee is normal. The acquisition fee is 22.5 on this. I mean, if you guys really want to negotiate, I would, but these are market in the MH space, and they're actually, you know, the acquisition fee could be below market for a small deal. If this was a $20 million deal, it'd be a 1% fee. If it was really a deal of this size, it could be 4 or 5.
I have one last question that I think is really important for me. Do you mind, Ben, if I take it?
Yeah.
Okay. So for me, my
Audio, please.
mic's off. They're like, no, you can't ask your question, Vina. Thank
Time's
you.
up, sorry.
So for me and our trust, one of the things that's really important for alignment is that we are supporting diversity in the C-suite level and above. So seeing women and minorities represented. So who is on your leadership team, and what does that look like?
So my COO is Nathan. He's a Filipino / his parents are Chinese Filipino immigrants. He's Filipino. He's a U.S. citizen. He's an attorney in my office. I pulled him away from the law firm to make him my COO. My director of construction, Juan's from Puerto Rico, also U.S. citizen. His brother works with us. My previous director of property management was openly lesbian, but she left the company for her mother got sick, so she moved back to Kentucky. Her daughter's still our treasurer. So I don't hire specifically for a DEI agenda, but that just happens to be how it's worked out. Nate, my CFO, is a middle class white guy like me. It is what it is. Whoever we got is who we got.
Absolutely. I appreciate that. Thank you.
All right, Ferd Neiman, everyone. Thank you very much. All right, we're going to continue our road trip from mobile home parks back to private credit land. Alex and Natalie coming up from ILS Legacy. Welcome back. Nope. I'm so sorry. I'm so sorry. We're going to go from mobile home parks to campgrounds. I got my order confused. Campgrounds are coming back with Kevin Houston from KCN Campgrounds. Nice job.
All right, my name's Kevin Thewison. I am a recovering CPA and one of the founders of KCN. We buy campgrounds and RV parks across the country. So our investment opportunity that we have today is a fund, and this is what the fund looks like. It's a 506C. We're targeting a $30 million raise. We already have about $10 million committed. We are holding these assets for a 7 to 10 year period, with the eventual exit being a portfolio sale. Target IRR on the investment for that time period is 20 to 25%. We do cash distributions quarterly. We start those after the second quarter of operations. So year one, we typically are in the 5% cash on cash. Get that up into the mid-teens by the end of the hold period, so it averages out to about 10%. We're using conventional financing at a 65% loan to value. And we have a LP waterfall to incentivize larger investment dollars into the fund, so anywhere from a 7% preferred return up to a 10, with a 70-30 or 80-20 equity split, depending on how much capital is being committed. So that's the structure of the fund. Now, what is it buying? And that slide didn't work. One on the left. It's not showing up half of it. Anyway. So the fund is going to buy about 10 campgrounds over the next 12 to 18 months. We've already identified these parks off market. We have a portfolio opportunity for 6 or 7 parks right now. We're in preliminary due diligence with the seller. Fantastic assets, and because of the relationship we have, we're able to phase the closings and the onboarding of those over a period of time, so we're not taking on all of them at once and overloading our operations team. The target criteria that we have for the parks that we buy, typically a minimum of $1 million in gross revenue, 150 sites. There's an opportunity for value add, so that could be expansion on land that comes with it or land that we can acquire next to it, site upgrades, reallocating the site mix between transient, long-term, seasonal, And then, there's a retail component, there's some ancillary revenue and things that we can do. And we look for parks that have a strong operating history. They've been around for a while. We can validate the numbers. We can see the growth. We know that they're in markets that people are going to come to, specifically with a strong tourism attraction. So is it close to a national park or a major metro, an amusement park? Is there a reason for people to be there? And then we also look for some geographic diversification, specifically with RV. People change their travel patterns depending on what the weather is. And if you have storms and things like that, if everything's concentrated in one area, you have some risk there. So our pipeline today looks a little bit like this. We're kind of spread out across the country, but we've identified strong assets that meet our criteria in markets that we want to be in. And when we can put all this together, what does it look like? So again, this is very early in the kind of due diligence phase, but when we took the 2024 P&Ls for the parks that we're looking at, they're about $14 million in total income, NOI of about $4.5 million. So we model it out and say year one, we're going to keep that flat. We'll keep our operating expenses similar. And then over years 2 through 5, we execute our value add strategy and start to pick up incremental revenue on the top line. And over a period of time, that's going to drive NOI growth. And then again, 7 to 10 year period, at that point we've stabilized, we've added the value, and at that scale, we can package it all up at a portfolio exit with ideally a compressed cap rate. We're targeting these at a 9 cap, and we see sales now of similar assets in the 6.5 to 7s. Wanted to touch a little bit on who we are and our team. So this is our executive team. One of the things I wanted to touch on is one of our board members, John Burke, was the CFO at KOA, Campgrounds of America. And he and I became friends, and when he was getting ready to retire, I asked him to invest with us, which he did. And then he joined our board, and through his relationships is how we're getting a lot of our deals. There's nobody in the industry that really knows the financials. He's been involved in hundreds of transactions on the KOA corporate side and the franchise side. So he and I work closely together. And then at our operating company level, we do have a family office partner, which is Ridgeline Ventures, that supports us. They are also one of our LPs. They participate in our deals alongside all of our other LPs at the same terms. And wanted to touch also on a case study. So for a full cycle deal, this was the first park that we bought. As in Green River, Utah. I bought this in May of 2018. It was a $1.25 million purchase. At the time, it was doing just under $390,000 in revenue. So over a 5.5 year period, we executed this value add strategy. We added an off-leash dog park. We remodeled the bathroom, the store. We upgraded all the electrical and utilities at the sites. We added luxury, premium sites with patios and covered gazebos, outdoor furniture, private dog pens. We did a 16-site expansion, added a cabin, landscaping, et cetera. So October 2023, we sold this for $3.36 million, at which point revenue was up 100% to $775,000. NOI was up to $395,000, and our camper nights were up 20%. And that's the boring fun stuff. And this is our operating team.
All right. Give it to Houston, everyone. Judges.
What percentage of your target occupants are people that are, occupants that are living in these parks versus people that are there for recreation, to visit a local campground or whatever it may be, or go hiking, that kind of thing, versus people that are living there for more than a week or two?
It depends on the park, and we actually have a mix in our existing portfolio and what we're targeting for this fund. So some parks are going to be, the overnight, and people are coming on their way to somewhere else, and so it's really a one-night stay. Mm-hmm. We have some parks where 20 to 30% of our revenue and sites are set aside for long-term or extended stay. Some of those could be there for a year or more. Some of them could be there for 3 months, 6 months. And then some could be seasonal, where they rent the site out for the camping season.
Okay.
So it depends on the market and the park.
Got it. Do you have any examples that you don't have to cite them now, but you want to get this all together, aggregate it, and sell it up to a big private equity firm? right?
Yep.
And that's the story I've heard from multifamily owners, and a lot of that's the exit for a lot of syndicators, right? Do big private equity firms, are there case studies of them buying portfolios like this in the past?
Yes. And within campgrounds and RV parks specifically, and the tangential glamping industry. So Marriott recently bought Postcard Cabins. I don't know the dollar amount of that, but that was within the last couple of months. KSL Partners bought Under Canvas several years ago. It was a $100 million transaction for a glamping resort. We have friends who are other operators that we know and work with that had an investment from El Catterton and a couple other family offices just last year.
Okay.
And an undisclosed operator that I know and have talked to just signed a $300 million private equity deal.
Okay. So speaking of private equity, that's in talking to the other judges and for myself specifically, my biggest reservation for this is being behind that private equity firm. And in essence, they're kind of pari passu, but they're coming in at a $10 million investment, so they're getting that high tranche. This panel's not coming in at a level that you would allow us to be, or maybe you will, to be at that 10% pref, right? So the way I've understood waterfalls to work, all the pref has to get met for everybody before we get any profit share. So although you're painting it as pari passu, we're in essence behind a large private equity firm that has a lot more money in this thing than we do. How do you mitigate any concern that I might have on that?
So the way that we've structured our deal with our family office partner is they have committed a certain amount of capital to our deals, but they are only obligated to commit 45% of the equity per deal. And so they're not funding 100% of our acquisitions. They're coming in while we raise additional capital. So while they are an anchor investor, they are not filling the entire capital stack. So the goal is we're bringing on other investors as well.
But we're still behind them though. If they're at 10% and we come in at a lower number and are at 8 pref.
Unless you want to write a bigger check.
I understand. Thank you.
No, there are ways that we can work around that, yeah. But
Such as?
The way that it would work is they participate no different than any other LP. So it's just based off of their capital commitment.
Okay.
I have a question. Okay, so I'm not a camping person. I like my house. I like running water.
We have running water.
I don't know things about this. So I guess I have like a way more basic question around this, right? So when we say campgrounds, do we mean like people are putting up tents?
Sometimes.
Or is it like an RV, and are they glamping, or like what does it mean?
It's a mix of all of them. So the majority of our business is coming from RV, which we love because we're really just renting the dirt. We provide the utilities, a place to park, amenities. All of our parks have pools and Wi-Fi and stores and recreation and all of those things, right? It's a resort style destination. What we like about RV is they bring their rooms, they bring their beds, they bring their bathrooms, they take them with them when they go. So all we're doing is renting the dirt. We have cabins, which can have kitchens, bathrooms, multiple bedrooms, lofts, bunk beds, all of that, which is more of a, it's like a hotel suite, just in a small frame. And then we do have some of our sites are allocated for traditional tenters.
Okay, and so then, like, people don't camp in tents for like months, do they?
No.
No, right? Okay. So how do you make assumptions or underwrite?
Sounded like Joe made it a few days before he gave up.
Then I'm done.
How do you underwrite for, like, this is obviously seasonal, right? In the winter, they're maybe not camping in tents.
Depends on the market, but yeah, there's seasonality for sure.
Okay, and so how do you know that you'll have more RV parks? I'm sorry, guys, I don't have so much time understanding what a campground is. How do you know that there are going to be more RV parks or RV tenants versus tent tenants?
So most of these parks have been operating for 30, 40 years. Okay. And so we can go back and we can look at how many people have come year after year. Okay. We can see who's coming every year. Are they coming multiple times? And we can look at the occupancy by site type to determine where's the best investment.
Perfect. Thank you.
Yep.
Round of applause for Kevin Hughes of the KCN Campgrounds, everyone. Thank you very much. And now we're going to make our third stop over to private credit. Please welcome back Alex and Natalie of ILS Legacy.
Good morning, everyone. Thanks for having us back. My name is Alex Davis, investment specialist for ILS Legacy Holdings, and this is my counterpart, Natalie Portra. She's our loan origination manager. You're actually going to hear a lot more from her today as she dives deeper into the underlying assets in our funds. So again, to keep the attorneys happy, we're not offering tax, legal, or investment advice. Please consult a professional. For a quick little recap, our ILS growth and ILS income funds are Reg D funds as defined by the SEC. This means that they are available to accredited investors only. These funds were established in 2018, and they invest in performing real estate notes generally written at 75% loan to value or less. So our minimum investment for both of these funds is $50,000 or more. We take both cash and IRA investments. You can add funds at any time as long as it's $5,000 or more. There is a 1-year lock-in period after which you can pull your money out with a 90-day notice. You can choose monthly distributions or compound on a monthly basis. We have no management fees, but we do have a 20% performance fee. This keeps our GP's interest aligned with that of the funds. Our target rates of return in the growth fund is 10% net return to investor or higher, and the income fund at 7% net return or higher, and we've been consistently hitting these marks for many years. At this point, I'm going to pass it over to Natalie, and she's going to go a little deeper with you.
Yeah, thank you. So like I said, as promised, we wanted to go ahead and go more of our assets. So also go into what does the growth fund incorporate and what does our income fund incorporate. So basically, our growth fund is going to hold all of our short-term fix and flip notes. These are going to be your typical 6 month to a year, depending on the project itself. And we also do our short-term bridge loans. These cover a number of different assets. These are going to be office buildings, storage, strip centers, land, you name it, we do it as long as the deal makes sense to us. To stay in line, we also have over the years mediated our risk and changed up a lot of how we handle the docs, we run the deals. At no point do we allow under a 600 credit score for any of our residential products. And then obviously commercial tends to be a little bit more high risk, so we do require over a 650 on that. You can see some of our loan sizes here at the bottom, and then we do less than $1 million for residential for an A-tier client, $750 for a B or C tier client. Our commercial loans range anywhere from $1 million to $10 million. Our sweet spot is $1 to $3 million, but we have gone up all the way to 20 for certain deals. Is it going? On the income fund, these are going to hold all of our long-term products. So for our rental loans, these are going to be anywhere from a 5-year interest only, a 520, which is 5-year balloon amortized over 20, and we also offer a 30-year product. For the long-term stabilized commercial property, obviously we want to keep our money in flex. We want to continue to roll it. So we offer only a 520 for this type of program. Our goal for this one is to get that product 100% stabilized so you can get into a bank loan. A little bit of our process. So as a loan origination manager, my team handles the borrower from day one. We get the borrower in, we discuss the opportunity and the project itself. We are there to review anywhere from their contract to their scope of work, the lease agreement. We review all of those documents. And prior to that, or once we're done with that, we go to an asset evaluator that also looks at it and reviews it to ensure that basically the value's there. And we then go to, by the way, these are the docs that we require. We are still a hard money lender. We don't want to have the tax returns and all that. We don't want to make it overly complicated for our borrowers. However, we do insure the borrower. So once we get through my process, the asset evaluator, it then goes to another team, which is our underwriting team or our QC department. Our QC department does not take any consideration of what I say or what the asset evaluator says. Their first initial quality control check actually hits about 160 different marks. This is anywhere from verifying the owner all the way to they had a foreclosure? Is there a bankruptcy? We cover all of that. Once that's approved, we actually move forward for appraisal. All of our properties require an appraisal, especially residential. Commercials can be a BPO, but everything is evaluated by a professional third party. Yet again, peace of mind. Our business actually started with $8 million of our own private capital from our 2 GPs. And come 2018, we needed a better source to continue to proceed with our loans, which now in 10 years, we've done over $10 billion in loans originated. We stand behind these loans 100%, and basically, we stand behind them so much that even our GPs maintain 1% invested into the funds at all times to remain aligned with our borrowers or with our investors. And historically, we stand behind them so much, we've bought back any foreclosure out of the loan or out of the funds to maintain them. So these may not be the sexiest thing ever, but they are consistent, and we've consistently hit our 9 and 10% mark, and we're very proud of what we do. Thank you.
Alex and Natalie with ILS Legacy. Excuse me. Thank you guys for the presentation. Judges, questions?
I have a question on can you go a little more detail? You said there's no management fees for the fund, but can you go a little more into if there are any fees? Because it looked like it was an average of like 10% to the investor, but you're getting, it looked like 14% plus 3 to 4 points for each loan, if I understood correctly.
Yeah, and I saw the 20% performance fees as well.
Yeah.
So just if you could put that together.
Sure, let me explain that a little more. Our notes are written between 9.99% and 13.99%. We've recently adjusted our lending rates to keep up with prime, but we still have notes in the fund that are written at that 10% mark. So it's really a blended return. We may not have just all 13.99 notes in there, so there may be some 10, et cetera. So the fund does kind of fluctuate a little bit, but we've been consistently hitting over 10% for years. We're actually a little bit closer right now to 11, but as long as we're hitting that 10% mark, we feel like we've done our job in the growth fund. The same is true for the income fund. Our target rate is 7, but because we've adjusted our lending rates recently, we're actually seeing a lot higher returns, so we're getting closer to that 8.5, 9.5 mark. But as long as we're getting 7, we've done our job.
And what's that, the 20%?
Sure, so our 80-20 split, that's a performance fee that's taken before everything. As long as the fund is making money, we get that 20%.
What do you mean by making money?
As long as there's money to pay out to investors. So as long as the fund is making money, then we get our 20% performance fee. So that keeps our interest aligned with that of the funds. On top of that, as Natalie mentioned, we do have over $1 million right now invested in our funds. We always keep at least 1%. So there is a very strong vested interest for us to make sure that these funds perform.
I have a question about your liquidity. You have mostly non-performing notes in this fund, and when you have like a massive event of liquidity, what are your checks and balances for that?
If we have a massive liquidity event?
Yeah, people just want to withdraw.
Okay, so if we have a run on the bank, per se, we do have a clause in our PPM that allows for us to kind of put a halt to it. At any time, we can always trigger that and say we're not going to pay out more than 10% of the fund's total capital on a monthly, rolling, yearly average. So we do have that in place to protect the investors that do want to stay in. We've never had to trigger it. We always make best efforts to pay out our investors. This is an investment. It's for a time period.
Thank you.
And to add to that, we actually, 2 of our principals have been in the investing network and investing in over 400 individual properties, apartments, and all of that. We've had over 20 years of experience. And what we are very known for is evolving with the markets and consistently changing our products to meet those standards and do best by not only our borrowers with products that are in or needed at that time, but products that also are for our investors and right for them also.
Thank you.
Can you guys talk a little bit about the tax treatment on this? What would we won't receive a K-1, right? Because it's a debt fund, so.
Yes, it's a K-1.
Okay, and so are we getting like a 1099 or 1098 INT?
No, it's just a K-1 that we provide.
We do get a K-1.
Yes, you do get a K-1.
Okay.
So is it ordinary income or capital gain?
It's interest, I believe interest income. I'm not a tax professional. You'd really have to talk to them.
Thank you.
But yeah, we do provide a K-1. We also don't trigger UBIT, so if you're investing through your IRA, you don't have to worry about that either.
When you spoke the other day, you had said that your loan tape or whatever it is about 350 million, right? And your fund size is 160 million, right? The concern that I had in hearing that is there is an opportunity for your organization to perhaps cherry pick what goes in and out of the fund. How do I, as an investor, mitigate the concern that we're getting access to the best performing deals and that you guys aren't taking the deals that aren't in the fund and giving to yourselves, other investors, selling them off to other partners you guys may have?
All right, the fox in the hen house, huh?
Yep.
All right, so we're not the fox in the hen house. We are the sheep herder guarding the herd. We only originate notes that we would be happy to own. When we originate, we don't know if we're gonna end up keeping it on our balance sheet or if we're gonna sell it externally or to the fund. Regardless of who we sell the notes to, if it's the fund, if it's an individual investor, or if we keep it in-house, we are with this loan from beginning to end. We have our own servicing department. We know everything about this loan. We only originate quality paper.
All right, Alex Natalie with ILS Legacy, everyone.
Thank you, everyone.
All right, and to close us out, we are going to take a swing at cannabis lending infrastructure. We're going to close out with Chris Reese from MJ REIT. Welcome back, sir.
All right. Well, good morning, everybody. My name is Chris Reese, founder and CEO of MJ REIT. But before I begin, I just want to say thank you to the judges. I'm truly humbled to be up here, so I truly appreciate the opportunity. So once again, this presentation is not intended to be an offer to sell or buy securities. That offer is made solely through the PPM, and past performance is not a guarantee of future results. So I figured I would start with a quick recap of what I mentioned a couple of days ago. So who are we? We are an institutional real estate lender, running a debt fund that has monthly distributions, monthly purchases, monthly redemptions, and monthly valuations, and we're 1099 tax reporting. So it's very easy to get in and very easy to get out. And we focus primarily on double-digit monthly income. And since inception, which is 2.5 years ago, our return is at 11.40% net of fees and expenses. And importantly, I'm going to come back to this point throughout the presentation, is we don't touch the plan. So what does that mean? So here's the opportunity as I see it. The revolution began in 1996 when Proposition 215 passed in the state of California, legalizing medical marijuana. 40 years into that, the entire West Coast had a legalized program. Rolling forward 10 more years, most of the country continues to expand with a few states popping up on the East Coast. And then today, if you look on the right side of the screen, 41 states, DC, and 3 US territories have a legalized program. So cannabis is not going away, and this is the opportunity. And because you can't cross state lines, when you initiate a program in that state, you need to have real estate to grow, to process, and to sell that. So it's independent, and there are steep barriers to entry because you can't cross those state lines. Last year, in 2024, total sales in cannabis nationwide exceeded $32 billion. And since the launch of cannabis programs, the states have collected over $21 billion in state tax revenue. Think about the schools, the roads, the social programs that can fund. And importantly, as we go through today's presentation, just keep in mind that we're not after and we don't finance those operators, but we simply finance a piece of commercial real estate. So on the banking side, today in the US, we have over 4,600 banks. Out of those 4,600 banks, about 563 allow operators to deposit cash, sometimes at negative interest rates. But if you look at the banks actually participating on the lending side, it's fewer than 25. On the institutional side, I made a point on Monday, if you look at the top 5 alcohol and tobacco stocks, 80% of their shares are owned by institutional players. If you look at the top 5 multi-state operators, that's less than 7%. So institutions just simply are not in this space yet. Our current pipeline, we will traffic in any one of the 41 state legal jurisdictions. Today our pipeline exceeds $130 million, but we can be very selective at the deals we fund. Last year, we analyzed over $200 million worth of deals and chose to fund only $17 million. Today, we are close to funding an additional $20 million over the next 30 to 45 days. This is the most important slide I have in the presentation, so I want to spend a little bit of time on this. So let's assume that 6 judges get together and they apply for a license to grow or cultivate cannabis in the state of California. So number one, you have to be awarded a license. And they find an attractive industrial building and they buy that industrial building for $2 million. But in order to grow, they need to outfit that building with irrigation, lighting, high-tech security, improved power. So they put another $6 million into that property. So collectively, the property is worth $8 million, right? Kind of. It's worth $8 million to a cannabis tenant, but in every deal we underwrite, we assume cannabis goes away. So I assume that the next non-cannabis tenant has no need for 14 air conditioners and state-of-the-art security, nor are they going to pay for it. So I would come into this situation, look at this building, and underwrite it at a $2 million valuation for a senior mortgage, 2 to 4 years in nature, at 75% LTV. So if I have to come in and kick them out and find a replacement tenant, my ability to do so and actually get a tenant at a lower valuation is much greater than if I financed it at an $8 million valuation. So importantly, we do not touch the plant, nor do we provide any benefit to the borrower for any of the improvements along the way. I'm very focused on governance at the organization, and I'm very proud of the board we've assembled. So I chair the board along with my partner, Matt Gould, who's been in the real estate side for over 40 years. Michelle Gillespie, she started her own firm focused on diligencing sponsors. Matt Malone, president of Opto Investments, a Joe Lonsdale company, and Jeff Mylock, who is a private equity investor as well. So very proud and happy and supportive of the strategic direction that the board's been able to provide. So in summary, just a quick recap, there we go. So why now? This is a strategy not intended to make you rich. This is a strategy intended to keep you rich. This is a timely opportunity that's not going to be around forever, 5, 7, 10 years. But when you determine the time is over, you simply redeem your shares and move on to another investment. There's no lengthy lockups. And again, I mentioned 1099 tax reporting and a $25,000 minimum initial investment. So with that, thank you very much for the time, and I'd be happy to take questions.
Chris Reese with MJ REIT.
Thank you.
Was that a plant? Yeah, come on. Right. Yeah, you get that? Oh, I get it with the plant. Nice green jacket.
What was the lockup again?
Yes, sir.
Remind me. You said no lengthy lockup. I forget. What's the commitment, period of time?
Yeah, so although we don't have a lockup, we encourage our investors to hold for 12 months. If you choose to redeem within the first 12 months, there's a 5% penalty.
That's right.
And that's to discourage short-term trading. After that, it's at 100%.
I have maybe a really basic question. What does adult use mean versus medical?
Yeah, good question. So the question is adult use versus medical. Adult use is also synonymous with recreational.
Okay.
So it simply means that anybody with a license over 18 or 21, depending upon the state, can purchase cannabis. Medical means you have to be approved by the state. Generally speaking, when you're medical, you're not paying state taxes on that.
Okay. So that chart you showed us with all the states in blue and green, the blue is anybody can, you don't need a medical prescription for it in the blue colored states, and in the green ones you need a medical prescription.
Correct.
Okay, awesome.
And so in the state of Pennsylvania, if you look, 5 of the 6 bordering states have a adult use program. So if I'm in Philadelphia, I go across the bridge to a cannabis dispensary in New Jersey, and guess who collects the state tax revenue? The governor has talked to Maryland, New York, Ohio, and New Jersey. 60% of the sales at the bordering cannabis dispensaries are Pennsylvanians.
Okay.
And will you remind me again, what are the projected returns for this, and when does it immediately cash flow?
Yeah.
Just talk about that.
Good question. So the projected returns, I'm very focused on a 10% annualized distribution paid monthly. So that's the expectation. We've been as low as 10.2 and as high as 16.67. And we close the fund once per month for new investors. So if you come in during the month of, let's say, February, March 1st, you become a shareholder and you begin to earn interest March 1st. We pay our interest by the 15th following month end. So your first distribution in that case would be April 15th.
I have another question around the TI build out. So, okay, if you're financing at a $2 million valuation and then they need to put another $6 million in to build out whatever they need, how do they finance that? Or are they bringing cash for that piece of it?
It's usually self-funded.
Self-funded, okay.
Because banks aren't lending, so you don't have a lot of
Right.
options. And usually what happens is you and I are successful in another business line, and we have built up a bunch of cash, and now we look at this as an opportunity. We just self-fund it. But then down the road, maybe we want to take $1 million or $2 million out for another project, and that's when we would step in.
Okay, and so you're always first lien?
Yes.
Okay, thank you.
And when they move out, if you have to have somebody move in, and I sort of asked this the other day, but when you, I guess, what's the potential expense? Because like you said, most other tenants aren't going to want all the stuff that they add to it. Is that a hefty process to remove all of that stuff if they don't need it or if it takes up too much space?
Well, so for example, with the HVAC, the new tenant may not need 14, but why remove them, right? They're just not going to pay for it. Some of the other equipment, like the irrigation and lighting, could be ripped out and sold on the secondary market. That process would be a few months in the undertaking. So in a situation like that where we have to kick you out, the biggest hit to the fund is an immediate loss of interest on that particular investment, on that particular loan. But we would be able to re-tenant that within a few months and be back in business.
Chris, have you had tenants that failed?
So not in this fund. We have 0 delinquencies and 0 defaults.
What about a previous fund?
So this is our first fund. Our manager, we have a couple of other funds that we have had to step in and re-tenant as well. So we have experience in doing that.
And did you re-tenant with another cannabis company?
Yes.
Okay.
That's the easiest way to do it because it's the quickest, the easiest, and we have a vast network of operators as well that we've already lent to, especially in the state of California, so we can easily re-tenant that.
I have a question, and it's an important one. On moral grounds, I am against it, and I'm sure there's many people here in the audience would like to hear that. So what would you say that would change my mind? I understand the medical purpose of it, but if it falls in one wrong hand, and I have to go back and answer to my daughter that if I'm investing this,
so
it's the right
against
thing.
cannabis overall,
As
a moral.
Yeah.
So here's the evidence and here's the proof. If you look at the opioid crisis that we have in America, if you go to a doctor, the doctor is trained to write you a prescription, whether it's OxyContin or another substance that it kills your body, right? Might provide you some temporary relief, but it kills your body. On the other hand, if you look at the medical benefit of cannabis, it's proven medical benefits. Yes, there's a recreational, and will some people take advantage of it? Yes, just like alcohol, right? So that's always going to be a part of it. But there's a proven medical benefit for anxiety, depression, PTSD. And if you can just take some of that away from the opioid crisis and have it focused on medical that's not addictive, I think that's a win. Thank you. You're welcome.
Chris Reese with MJ Reed.
Thank you.
Thank you. Good job.
All right, and that concludes our third round of the Pitch Slam. One more round of applause for Alex Natalie of ILS Legacy, Chris Reese from MJ Reed, Kevin Houston from KCN Campgrounds, and Ferd Neiman from Third Fourth Properties. Another round of applause for those folks. Takes a lot of courage, a lot of guts to do that. And our judges, Joe Fairless, Osh Patel, Vina Jetty, Lisa Moore, Davi Chain, and Matt Fairclough. Thank you all so much. Thank you guys for being here. That's going to conclude this. Don't go anywhere. We've got the last and most important presentation of the conference coming up for you. And in about 30 minutes, we're going to find out who wins the third annual Best Ever Pitch Slam. Is it going to be cannabis? Is it going to be mobile home parks? Is it going to be campgrounds? Or is it going to be private credit? We'll find out.